get started today. I'm going to introduce Jeff Ellis here in a minute. Bruce, first, we've been on town in London. Touch base with everybody.
Just want to let all of you know that I lost track of a couple of you for a couple of weeks here. I'm in transition myself. Just like many of you, I'm looking for a job. So I'm feeling the same rushes of adrenaline and higher highs and lower lows that some of you are feeling. And Kelly sent out an email suggesting that if you wanted to contact me, to use an alternate address, which is bsf@sbcmkps.com. That's how you get a hold of me. I've caught up with most of you since this lapse, but for those who felt it drift, I apologize and feel like I'm back on track and hopefully can continue to be helpful to those who contact. That's it.
Thank you, Bruce. Our presenter today is Jeff Ellis, Crosstree Capital. Jeff graduated from New York in 1996 and went into credit at Bank of America and then on the Bank of America Securities. I'm going to let him introduce his bio because that's part of the content of the presentation. I think today it's a very good presentation. I've gone through it and I like it a lot. And one of the things that's interesting about a small M&A shop is he's going to talk to you a lot about this as a business rather than as analyzing companies. And I think it's a great presentation in the sense that it tells you their business model, which has been very successful in defining a niche and how you add value in this process, and the presentation reflects that. You'll take questions at any time?
Oh, absolutely.
Jeff, thanks for coming.
Am I on here?
I think so.
Okay. Well, hello, everyone. Thanks for taking time out to hear what I have to say today. I'm going to start out with a little bit of background on myself, and I want to make it as transparent as possible and show you all of my historical shortcomings to let you know that everybody looking at kind of the investment banking industry overall, it looks very illustrious and impenetrable in a lot of respects. If you didn't go to Harvard or you didn't go to Wharton, it's how do you get in? How do you get the attention of Goldman or Morgan Stanley or one of the big shops to really get your foot in the door? So hopefully after I go through my background here, you'll gain some confidence because you'll see if a knucklehead like me could find a way into this industry, then you guys should probably be able to give it a shot as well. But I really started out with my undergrad here and graduated in 1996. I'll step back a step further and say that when I first got into college, I didn't really have any kind of driving force behind me, any kind of parental force to you need to do this with your life, you need to do that. Everything was kind of left for me to figure out on my own. I got into college and I decided I wanted to be a philosophy major because it was very, very interesting to me. I loved reading philosophy books, and so I started taking classes in the philosophy program here at UF. At the same time, or subsequent to that, I realized that I needed to get a job after I graduated as well, and philosophy wasn't really going to do that for me. So I got into finance classes too, and my father was a dropout out of college. He became an entrepreneur, built up mortgage companies, did pretty well for himself, but was one of those guys that was like, all right, well, you can go to college if you want to, but that's for people who can't really go out and cut it on their own, out in the world. So I didn't really have anybody pushing me in one direction again. But as I went through my undergrad career, I tried to double major in philosophy and finance because I wanted to, enjoy the, the readings in philosophy, and it got me thinking. And I enjoyed finance too, and found it to be analytically challenging. And at the end of the day, it meant I was pretty lackluster in both categories, and got out of undergrad with not the strongest of GPAs, not a whole lot of direction and where I wanted to go from there. So at the same time, to add even more flavor to this, I was playing in a band that was actually,
Right.
yeah, it gets even better. It was actually becoming very successful, and we toured all around the Southeast. We had our own original music. We were starting to get record label interest. It actually looked like something that could feasibly happen, at least in my mind back then. Also had a girlfriend, now my wife, who was doing her master's at UF at the time too. So I stuck around after I graduated in undergrad. I got a job at the credit union here locally, doing consumer lending. So I did something, remotely financed, but certainly not challenging by any means. It was just a job. So, a year or two into that, actually 97 or so, I said, all right, I need to make some changes and get some direction here. Was talking with some people who I had known who were working at a company by the name of Geneva Corporate Finance, which is currently a subsidiary of Citigroup Global Markets, which is the investment banking group within Citigroup that was doing all the smaller deals. At that time, they weren't a sub of Citigroup; they were standalone. But they did M&A work on deals between, let's say, $10 and $50 million for the most part. All kinds of general industrial and consumer and retail type companies. So I went over there, was able to get my foot in the door there. It's certainly not a stable of Wharton and Harvard pedigrees there. It's just kind of average Joes like myself at that time that got in. When I got a taste for that industry, I just fell in love with it because I found it to be completely fascinating. Every deal you got into, as a generalist especially, you got into a company, you got to understand all these different industries. You got to really ride all the deal psychology and the ebbs and flows of a deal and its life, which, no case is like any other case. It's always an interesting, you're always learning, which is what I really enjoyed about the industry. So when I got my first taste there, I just dove into it. All right, I've found what I want to do, so I need to find a way to do it even bigger. So I dove into the CFA program, started studying that, while I was doing my MBA actually at USF at the same time. So I just wanted to know everything finance possible so that I could, move up into this industry. So I got out of my MBA program at USF in '99 and started figuring out what I wanted to do from there. At that time, venture capital was all the buzz. All the internet companies were all the young punks like me were making $1 zillion within a couple of years. So I thought, all right, I need to give this a shot, and started looking for jobs in that industry. Came across Bank of America because they were actually a chair on the Florida Venture Forum within the state here, and got to know the people there. And one of the groups that they have, which was really the kind of upper echelon of the commercial bank, is the best way to put it. They worked with it was more like a corporate bank. They worked with all the larger clients. For example, in Tampa, they worked with Outback Steakhouse. So you got a lot of exposure to a variety of corporate finance situations. Certainly a lot of it was focused on debt and lending, but there were syndications within the debt, and certainly the clients were also doing M&A work or follow-on equity offerings and whatnot, all kinds of corporate finance activities. So you got exposure to all that, but more importantly, you interfaced a lot with the investment bank, and through that, I was able to really get an appreciation for how a big Wall Street investment bank works and what it takes to really perform in that environment. So there was a group within Bank of America Securities, which is the investment bank, called the Mid-Cap Investment Banking Group. And essentially that was created to bridge the commercial bank and the investment bank because after the Glass-Steagall Act people could, the big commercial banks could come in and buy the investment banks, and they needed to find a way to create synergies because everybody was doing it. Everybody felt that they needed to have the full suite of offerings. So this group was really a liaison to kind of create that synergistic value, and that it was business development from all corporate finance perspectives, whether it was IPOs or equity capital markets in general, M&A, lending, high grade, high yield, the full gamut of B of A Securities corporate finance offering came through this channel into the commercial bank. So basically we were responsible for digging through the commercial banking portfolio of more traditional commercial clients and finding opportunities, helping structure those opportunities, and working with the right product team, the right industry group within the investment bank to get deals done. So we got execution experience there as well. So that's where I really made my foray into a bigger institution and really got a feel for how a big investment bank works. And from there, I was there and I kind of elevated up the ranks to vice president, got some really good experience. My partners, who currently I had worked with at Geneva, my prior company, I had found out had built up a small practice within William R. Hough and Company, which you guys are all familiar with, doing M&A work. I kept in touch with these guys, and about 2 years ago, as many of you probably know, Royal Bank of Canada came in and bought William R. Hough and Company. At that time, I left Bank of America Securities, teamed up with my partners, and we bought the practice out of William R. Hough and Company. We rebranded it Crosstree, which is what we are today, and here we are. So I'll give an overview of what Crosstree does in general. We are a specialist investment banking firm. We provide mergers and acquisitions advisory. It's primarily sell-side advisory, meaning we represent selling shareholders that want to exit their position within a company and in a change of control transaction. We also assist companies with raising growth capital, whether it be private equity into a much more limited extent venture capital that want to grow their business in one way or the other that's requiring funding. So the unique aspect to our business is that we focus very, very narrowly on certain sectors of the life sciences industry. So we work with pharmaceutical services firms, which are those companies that provide, for lack of a better term, project management through the clinical trials process that all of large pharma and biotech has to deal with in getting FDA approval. We also work with diagnostic products and services companies, which are your Quest and your LabCorp type labs that are doing blood processing and telling you what your cholesterol levels are, as well as the instrumentation manufacturers that supply the instruments to Quest and LabCorp to do that work. So we found that being immersed within these really small subsectors, small meaning pharma outsourcing is about a $6 billion market, so it's small in relative terms. But we found by focusing in these areas that we have been able to just penetrate the market, get relationships with all of the players in the industry, get into all of the deal flow within these niche categories, and really just kind of dominate and throw our arms out so no competition can get in, because we're typically not competing with firms that are as focused as us. So we've been very successful in that right. We've also developed global capabilities to really follow the industry and its evolution. It's experiencing a lot of globalization, so we felt it was necessary to partner with firms overseas. So we have an investment banking partner in India, we have an investment banking partner in Europe, so we can provide our service on a global basis. So I'm going to tell you a little bit more about Crosstree, and then from there I'm going to just kind of give you an outline of what a generic M&A process looks like, and then more importantly, to close up, I'm going to go through a case study of a deal that we worked on, because the generic process just really doesn't do it justice. You need to get into a case study to see all the different twists and turns a deal can take through its life. But the premise behind Crosstree is to really go into these niche categories within an industry, find the underserved markets. And when I say underserved, I mean Goldman Sachs and Morgan Stanley aren't there competing with you every day. And the industries that we've identified essentially have some common traits. They're very consolidated at the top end. Within the diagnostic services space, for example, you have Quest and LabCorp. Those are the two big players. They're huge. They're doing a lot of M&A work, but there's not a whole lot of fee potential to Wall Street from that M&A work. They're pretty sophisticated and savvy in what they do, and they don't really need representation in most areas. So it's not an industry that Wall Street's paying a whole lot of attention to from an M&A perspective. That being said, the bottom end of the market is very, very big. There are a lot of players on the bottom end. There's a lot of consolidation going on, and that's where we make make our living, is working with these companies between 10 million and 150 million in enterprise value that are doing deals in that space within the industry. So, what we found is that when a selling shareholder is selecting an M&A advisor to represent them, really the decision is primarily made on, well, first off, if you have somebody who comes in and says, all right, I did a deal that's exactly like your company, and we just closed it, last month. I mean, you have the deal. You have shown that you were successful with a similar transaction. You have real-time knowledge of the market. You know who's looking to acquire a company like this. You know what valuations look like. So, the client's going to sign you up. It's going to be hard for anybody to beat you out in trying to get that business. So we have really delved into these subsectors to try and create that competitive advantage so that we can continue to sustain our business and not have any meaningful competitors at this point. So
it's a great story, obviously, but did you know something? I know the guys, I don't think so. You didn't know something about pharmaceuticals and then by accident find out that it was fragmented, or did you just look at everything and try to find something that was fragmented on the sell side?
That's a great question. Really, this business model was kind of developed out of William R. Hough. So it developed with my two partners while I was at Bank of America Securities. They started out as generalists. So they started out trying to go into whatever industry made sense, getting leads however they could, through William R. Hough, through their network that they had. They got killed. I mean, it's a really tough business to be a generalist out there. You don't add a whole lot more value than your process, your ability to run a process. You have to get up to speed on every industry you go into, so it's tough to compete, especially when somebody over there had just done a deal in this industry before. You can't knock them out. So they kind of landed in this specific sector. They found a client there through a referral, through a generalist type referral, signed up the client, got a deal done, got more familiar with the sector, and realized that, all right, if we're going to be able to build a sustainable business here in this cutthroat competitive market, we need to create some kind of competitive advantage that will last for us. So I quickly realized that this industry, as they dug more and more into it, was a perfect place for them to start out. They had just done a deal, so they had relevant experience that they could go out and share with the marketplace. They knew that the marketplace was consolidating. They knew it was very consolidated on the top end, but there was still a lot of deal activity on the lower end. So they knew that there wasn't a lot of Wall Street attention being paid to it. So from there, started going to industry conferences, becoming a regular face at industry conferences, getting to know all of the executives at the various companies out there. Started doing publications that track valuation data, track M&A activity, track growth capital activity. Started distributing that very broadly within the industry, so that goes out on a quarterly basis and still does to about 4,000 participants within the industry. So really built the brand is what it all came down to. Just spent a lot of time and spent some money building the brand, and from there, once you get some transactions done and show some success, then all of a sudden you have a business, and that's where we're at right now. I can say that we took this practice out of William R. Hough 2 years ago, and probably within the last 6 months I can say, wow, we have a real business here. We have infrastructure. This is scalable even. We could take this from the sectors we're in right now. We can implement this model into other sectors, and we can do the same thing. So as of right now, we're doing more deals within pharmaceutical outsourcing than anybody on Wall Street even, which sounds very big and grandiose, but that means we did 4 deals last year in pharmaceutical outsourcing. It's a small space. So,
2 questions. One, what's the current thinking on a minimum fee for a bulge bracket firm and an M&A advisory assignment today?
While I was at Bank of America Securities, it was $500,000. You need to be able to cross that threshold. It's a great question. Yeah. I would say our average fee is. It's not too far from that. It's probably $350,000, somewhere around there, $350. So we don't see the big guys coming down into deals that are south of $50 million typically. That's kind of the lower.
Fair to say that even to justify a $500,000 fee to the fee committee, you'd have to work pretty hard at UBS.
Absolutely, yeah.
They don't want you coming in with anything less than $1 million, $2 million.
Yeah, that's the very, very bottom end, and it would take some selling, definitely.
One other thought here. You figure you can replicate the model. 5 years from now, do you still see yourself as middle market? Is it better to probably try and stay in that?
It's a good question. We feel a natural evolution upstream. I mean, as we get more sophisticated within this industry, as our brand becomes more well-known, I mean, the challenge is, do you end up really labeling yourself as, oh, these guys do all smaller deals, whereas, you know, the bigger guys just aren't going to want to sign you up because they look at all your last deals, and you know how people are. It's even though you might do all the same work and get the same outcome, there's just some kind of allure to doing bigger deals. But what we've seen, for example, right now we have a client that is getting value indications around $140 million. That's a huge deal for us. We would have never touched that, you know, a year ago. Most of our deals, you know, our sweet spot's probably $20 to $50 million, which is where we can really survive and do well. And there's only one reason why we got this bigger deal. It's through the relationships we had, the knowledge of the industry. We actually brought in a couple of buyers that, you know, our client had no idea would be interested. So, and nor would any other investment bank who wasn't really focused as intently on our markets. So hopefully we're moving upwards and onwards, but yet to be seen at this point. So I think I've spoken enough about what we do, but I'll walk you through the process of an M&A transaction to really give you a feel for, you know, what is an M&A transaction, what steps are taken to really create a market, and what's the value proposition of an M&A process. But to start that off, what our typical M&A client is after is, you know, they want to sell their business, so they want the highest possible valuation they can possibly get out in the market, and everybody thinks they're worth, you know, the very top end of the market. We deal with a lot of entrepreneurs that have built businesses up over the years, and, you know, rightfully so. They think their business should be, you know, worth the highest possible valuation multiple that they've ever seen before in the industry. So our job is to try and deliver that to them in the shortest amount of time with, you know, no breaches in confidentiality. So it's always a balance between getting the highest value and protecting your confidentiality, because you can go out to, you can go out to a very broad audience and probably bring in more offers from firms that, or from companies, potential buyers that may not make perfect strategic sense, and you could probably, you know, bring in 15 offers, or you can go out to, you know, a limited universe of 20 or so highly strategic, you know, very synergistic companies that could buy our client, and bring in 5 or 6 offers or so. In the broader auction, you know, you're going to go out with all this confidential information on your client and distribute it a lot more broadly, and hence you're going to have more leaks with the information potentially. So it's a balance, and we typically advise our client on it and do what they are comfortable with at the end of the day.
The desire for confidentiality, maybe it's obvious, but well, to me, is that they're worried about proprietary technologies, or they just don't want people to know they're for sale?
Both, yeah. I mean, this probably more so the sale in a lot of cases, because, you know, if a competitor finds out you're on the market, then they're going to go to all your customers, oh, those guys are for sale, you don't want to do business with them, you know, you're in danger, which, you know, is rarely true, but it certainly gets used against our clients if it was breached. But this kind of gives you a graphic depiction of, you know, a banker-run process versus a non-banker-run process, or lack thereof a process, I guess. So on the left-hand side, you know, you have this potential universe of potential buyers. We have these as ABCs because we'll typically go through and screen, do a thorough screen on who we think the potential buyers are for one of our clients, and we'll rank them based on, you know, what the strategic fit is, what their financing capabilities are. And we'll tier them according to that. So we usually come up with 3 to 5 tiers. So A, B, and C, you know, a middle market company typically is, if you're a good company, you're already getting knocks on your door from potential buyers because they know you're a strong asset and they want to tack you onto their business. But you also might get some referrals from your attorney, from your accountant, and the result of that is that you have a very choppy, not a very well-managed process. And at the end of the day, an M&A advisor's job is to create efficiencies in the market where there really isn't a mechanism to do so existing other than a banker. So, for a privately held company with $20 million in revenue, you want to sell your business. There's no freely traded market for that. It has to be a negotiated transaction with one party if you choose, or 10 parties if you choose. Unlike a publicly traded company where you're listed on an exchange and you can pull it up any day on Yahoo Finance and figure out what it's trading for. So the question to our clients have to ask themselves is, all right, well, this one buyer came and knocked on my door and they think I'm worth $30 million. Is this my best deal, or would these guys pay more if there were other buyers at the table and there was competition? Because that's really what, when you're a publicly traded company, you have supply and demand and you find equilibrium, and there's, competition for the asset and there's a supply of the asset. So in typical cases for private companies, that doesn't exist without a banker coming in and really running a process that brings in all the participants that may have an interest in the client to the table. So the real economic value proposition is, after you go through 5 to 6 months of work getting to the point where offers come in for your client, is you get 5, 6 offers in on average for your client, and you're able to drive that valuation up through negotiating with each of those parties, and at the end of the day, your client and you can feel comfortable that they have seen all their options and they have seen the top end of potential valuation for them at this point in time. So that's what an M&A advisor does. So I think that covers that slide. This is just a further graphical depiction that furthers the same points I just made. On the left you have several different parties. It's also critical to have a well-managed process with regards to time. You want everybody to fall in line at the same point in time. You want offers to come in all at the same point in time. You don't want somebody making an offer here and then 2 months later getting another offer, because it's hard to build the competition within the market that way. So, theoretically, a banker is supposed to deliver this on the right-hand side, where all parties come to the table at the same time. They are all equally educated on what the opportunity is. They've all been provided the same information. They've all been, quote-unquote, positioned by the banker, is what we like to say, and as to what the investment highlights are in the company and why this is a very strong asset for them. And then, there comes the money, and hopefully we're able to drive up valuation for our clients and get them a very good deal.
Talking in the funnel there or anywhere along the process, when are you, as that funnel shrinks, when are you talking to corporate people on the buyer side, and when are you talking to their bankers?
It really depends. A lot of I would say 90+% of the time we're dealing directly with a corporation. It may be a bigger company with a pretty sophisticated corporate development function, and which is all staffed by prior bankers that are in there doing deals for them. And probably in the other 10% of the time there's a banker on the other side of the table. But it's typically harder for a banker to work on the buy side, quote unquote, when there's a real process going on the sell side. Because a buy side banker's real value is, hey, I have this proprietary look at this company out here in the market that hasn't hired a banker yet. We can go get to them first and hopefully get a lower valuation than when the banker would come in. So
it would be difficult the confidentiality is harder to maintain when the bankers on the other side.
When do you think it reaches a level, what my board of directors had on, I don't want my new business development people doing a deal without a banker. I want that to protect my own fanny. I want that intermediary. You understand where I'm going here? When do you think that happens? What level?
It's hard to really put a level on that. We work with some big companies. We've done deals with AmerisourceBergen, which is a pretty big company in the healthcare sector. they don't use bankers, or they didn't use bankers. I would say the level would probably be more based on the value of the transaction, and maybe that's where you're going here.
Where I'm going
The
with
fairness
this
opinion, is that where?
Crosstree represents the seller. And I'm on the board of the buying company, and our development people don't use an investment bank. And a year later, the property we bought blows up. We're going to get sued. Where's my due diligence? In-house due diligence? I don't want to be in the courtroom defending that. I want to be able to say, we hired an investment bank, they interacted with the process with the people from Crosstree, they gave us an opinion that this was a fair price to pay for this property. That's what's going on out there. Increasingly, you're going to see boards demanding that, and the fight is, as Jeff said, all these development people are ex-bankers saying, we don't need an investment bank, we can do it. Introduces an interesting dynamic.
Yeah, and it's completely an insurance policy at the end of the day. It's and the level is really, we're typically advising clients with maybe $30 million enterprise values. So if we're selling to AmerisourceBergen, they don't need that insurance policy on that. They're comfortable. If it's a merger or something where the two companies are a little closer in size, that's a much more highly visible transaction. So I mean, the deals we do, sometimes they don't even get reported in an 8K or in the 10Q going forward. So, but if it was companies of close size, you'd have to. The acquiring company would want to go out and hire a banker for exactly that reason, and the banker would charge them through the nose for a fairness opinion, which is essentially a valuation on the company where they're going to go look at publicly traded comparables, precedent M&A transactions. They're going to run a discounted cash flow analysis, all to kind of triangulate value and say, all right, you're paying a fair price for this company. And then the buying company is going to file that within their filings so that all of America can see it, or all of their shareholders can see it. So, and it's an insurance policy. So, for maybe 2 or 3 weeks of hard work on a fairness opinion, bankers, a bigger Wall Street bank is going to make, $500,000 to, lots of millions of dollars. But again, they're taking liability, so that's what you're paying them for too, is they have the liability at the end of the day. So it's like an accountant coming in and doing an audit. What are you paying them for? It's the same thing. It's liability. So, great question.
This is not the area that you're in, the biotech stuff, but can you talk a little bit about the Time Warner AOL merger? By your metrics, it seems like if you were guiding AOL in that process, you'd be very happy because you got a good price. But my understanding is the Steve case, he's taken a beating, an absolute beating in the press, and I think that most people would look at that as a total disaster. And so, from your point of view, if you had a deal that went like that, obviously the reputation is very severe, and you're going to pay a lot for that down the road. But can you talk a little bit about that deal? And then, what are the aspects of large deals that are comparable to what you do? And what are the aspects that are just totally different?
I guess first off, I have to claim ignorance on the Time AOL deal. We are so buried and focused within our little tiny subsectors of these industries that, if I was at B of A, 5 years ago and you asked me that question, I'd probably have a great answer for you, but I'm just unplugged. We have blinders on and we focus on what we focus on, and we do very well at that. So I don't know all the details of the situation there well enough to have much of an opinion on it. In terms of the second question, whereas how do the smaller deals that we would do compare to bigger deals like that? It probably goes back to the point on liability. When we're doing smaller deals, they oftentimes don't get reported. They're not even required to be reported in the statements. So what you see sometimes is, some companies will step up, some buyers will step up and pay valuations that their shareholders would be pretty upset with, we think. at the end of the day if they knew all the details of what was going on. But they don't know what's going on. It's probably a very strategic asset for them, but we've created a competitive process and caused them to pay more than they probably should have at the end of the day. It certainly happens. And we don't feel all that bad. We're getting our client a good value. But that's the big difference is, just how visible the deals are. And do you need a fairness opinion? Do you need all these kind of insurance protective type measures to protect you from your shareholders, year down the road when things go awry, if they do go awry. So we don't have to contemplate that a lot of the times in the work that we do. But I did see a lot of that at B of A. I mean, when you're at the bigger firms, that's something you deal with on a regular basis in your deals.
I got a thought here, Jeff, maybe you can piggyback on it. Jason, I do not discount the imperial CEO factor here. That's probably what drove 6 out of 10 of those kind of transactions, ego. And I'd just like Jeff to piggyback. The business he's in is a CEO product. He doesn't go calling on treasurers, he doesn't call on CFOs. It's all about ownership. It's a CEO product. Fair?
Oh, absolutely. Yeah. Yeah, there's, if we deal with anyone, it's the CEO or the shareholders. If there's a board, we'll deal with the board. Private equity firm that owns the company will deal with the board again, but it's comprised of private equity directors. We'll interact with the CFO to do our financial due diligence and put our work together. But beyond that, these processes with smaller companies like we deal with are typically very contained within a very small number of people. We'll go down to the chief operating officer if that person's a key employee and needs to be involved in the management presentations and whatnot. But yeah, when we sign an engagement, we sign an engagement with a shareholder. We sign an engagement with an owner. There's no other way to do it. So these are some high-level steps to a typical M&A process. And as step 1, I have that we advise the client as to strategic alternatives. Oftentimes our potential clients are considering various routes in either creating value in their company or realizing value today. So they may be looking at, all right, should we go out and raise some growth capital from a private equity fund and make some acquisitions, or should I just sell today because the market is really hot right now and valuations are strong? So there's a lot of economic and financial analysis we'll put into that to help our clients see the economic detriments and benefits of all the different alternatives that they could be assessing at that given time. Once an alternative is selected by our client, we'll design the process and put the marketing materials together. So by design the process, that means, again, back to this balance of confidentiality and value. Does our client want us to go out to 100 different companies all over the place? Do they want us to go out to 10 different companies? Are they so concerned with their confidentiality that they want us to just talk to these 2 people that they know they fit perfectly with? It can vary dramatically, and we've seen it all across the board. So then from there we prepare the marketing materials, which is typically, actually I'll go through all these in a little more detail. Next we'll execute the marketing program using those materials. Next will be preliminary due diligence that the buyer will do on our client. And then we'll collect final bids. We'll negotiate those offers and try and drive value up for our client. Our client will select a buyer at that time to do the deal with. And it typically takes about 5 to 7 months for us to execute a process like this.
Is the client pick always the highest bid, or is there...
No, absolutely not. Chemistry has a whole lot to do with it. They're almost, in the majority of cases, we've had... at the end of the day, you'll come in with a variety of different structures too, so it's not always value, it's value and structure. So, this particular buyer could be offering a value of $30 million, but it's all in their stock, and they're a $50 million market cap company that's very illiquid. And what's that worth? Really, $30 million? It's not worth $30 million in cash, to me at least. The next buyer might come in with, hey, we'll give you $22 million in cash today. You walk away. So totally different set of options. And then the next buyer might be a private equity firm that's going to come in and say, well, we'll buy out 80% of your stock. And we want you to ride with the remaining 20%. But we're going to go out and do acquisitions. We're going to consolidate this industry. And in 5 years from now, your second bite of the apple, quote unquote, is going to be much greater than what you're going to realize today. So to answer your question, it really comes down to our specific client's risk profile, what they want at the end. And our job is really to, as much as possible, create an apples-to-apples economic assessment of all of these different alternatives. So we spend a lot of time doing that. So good question.
Kind of follow on that. I mean, over the years, we've had people in this forum that do similar kinds of things. It just struck me, a lot of them, or some of them have been in private equity or this kind of situation. What's different about yours, I think, and you can elaborate on whether this is true. They were always metal benders, kind of people, and the typical motivation for exit was probably lack of a son or a daughter to run the business. The classic kind of thing where somebody had run the thing, made a lot of money, and was 60 years old. But these are operating companies, that are fairly entrepreneurial, right? And so when your client sells out, they will still be working. So that's part of the chemistry as well.
Absolutely, yeah. Yeah, I mean, I would say more than transition within the family, which we don't even really see that much of in our industry. It's market timing. Is my company, given that the market is so active right now, is now the time I need to realize value, because our clients are usually fairly sophisticated, relatively speaking, for smaller companies. Because most of the time they're very highly educated. A lot of them are PhDs, because we do work in a very scientific community. So they're trained on the science side, which is they're all very smart for the most part. And usually, if they've been able to build a business, they have very good business acumen too, because they're just smart people in general. So our conversations, even for a $10 million enterprise value company, are typically very high level, sophisticated. We have to deliver, really good quality insight to them.
And a deal for the seller position in the combined firm is part of the transaction, probably. The seller usually walk away, or he has a job, or she has a job within.
That's a good question. For a smaller company, that is, typically in the case of a smaller company, they're very owner dependent. So when a buyer comes in, they recognize that immediately. Any good buyer should. So if you have a company that you built up to $10 million in revenue, it's probably in our industry it's a 50 to 70 employee company. You probably, as the CEO and main owner and probably the founder, you probably are responsible for generating 75% of that revenue through your relationships that you've had over the years. So a typical structure in a deal like that is what's called an earn-out. So the buyer will come in and structure a deal where they pay they'll assign a value, and they'll pay maybe 70% of that value at closing, but they will require you to hit certain revenue hurdles or earnings hurdles for the next 1 to 3 years to make sure you're still incentivized to keep the ship going while they can figure out how to transition you out. Because certainly as soon as that 1 to 3 years hits, your CEO is probably out of there, waiting for the non-compete to expire so they can start up the next one. But yeah, that's usually you see structures like that, and deals usually get done with some kind of structure like that for smaller companies. So I talked about this a little bit, just the first step of the process, which is to advise our client on what their alternatives are so that they can make the best decision for them. Again, some of the things that people will be faced with are, do I want to grow my company? In which case I might need to raise capital, which, I'm going to dilute my ownership. I might own, 60% of my company after I raise some capital, whereas I own 100% today. But with that capital, I can create this much value into the future, and I can buy this company and that company, and in the future, my economic value, given my smaller ownership position, is going to be much greater. So So that's something that people assess. Estate planning, retirements, things like that. If people are just ready to retire and get out of their business, that's another motivation. There may be ownership, different factions within an ownership, or shareholder base within a company, whereas, there may be some venture capital groups in there that need to get out because they're kind of at the end of their holding period, or there may just be 3 founders that, 2 of them hate one of them, or one of them hates 2 of them, or whatever it is, all kinds of different scenarios like that, and you just kind of have to address each one individually and approach each one with that perspective so that you know how to advise your client.
And you've mentioned grow the company or sell the company.
Mm-hmm.
Those numbers were interpreted correctly on the earlier slide. 90% of the time, at least for the deals you do, it's sell, right?
Yeah, and I wouldn't say that that's indicative of the decision-making process with our clients. That's just the kind of business we like to do. So we go after mergers and acquisition.
You got my follow-up question.
Yeah.
So if somebody's interested in raising capital, you're not quite as interested in chasing them.
Yeah, exactly. Yeah. So we'll advise our client on the various aspects, including valuation. We'll give them suggestions if there are tax planning things they need to do. We certainly don't give tax advice or legal advice, but we can spot it when it's needed. So we may bring in or suggest they bring in advisors to help them on things like that. A lot of times when we're working with smaller companies, their financial statements aren't audited, so they don't want to pay $100,000 to KPMG to come in and do their audit. They're only a $5 million, $10 million in revenue company, so that's a pretty big, expensive item for them that they've never needed in the past. So we may come in and kind of do a pre-audit where we'll look at their revenue recognition policies and all the accounting aspects that are prevalent within the industries that we work in, at least. And again, we're not accountants, but we know accounting pretty well enough to clean the numbers up and make sure that they're crisp when we go out to market. And then we'll establish a preliminary timetable too. You have to set timing expectations with your client. Some clients think that these things take 1 to 2 months, but you have to advise them otherwise.
If going back to the accounting, are most of your client companies, assume that they're not audited, but do you see the Sarbanes-Oxley Section 404 controls issue creeping down the ladder as well?
Absolutely.
Can you talk to the students about that for a second, what that means?
Yeah, I don't know in depth all of the details around that, but there are all kinds of standard operating procedures and controls that have been put in place through that regulatory move with publicly traded companies primarily, but it is affecting privately held companies too. And one example is, we had a client that we brought in offers for about 9 months ago. We did a deal for them, and they had, one of the buyers was actually a company with a market capitalization of sub $100 million, less than $100 million. So for companies like that in the public markets today, it's really, really tough to comply with all these regulations. First, to understand all the things you're supposed to be doing so that you're not at risk for all the things you just don't have time to know about. And then secondly, to pay the expenses that are necessary with some of this, whether it's the accounting system or the compliance people, just to provide oversight. And again, I don't know all the details of the regulation, but in this case, we had a buyer come in that was less than 100 million market cap, and they actually put in their offer that we had to bear all the burdens. My little privately held company had to bear all the burdens of their Sarbanes-Oxley compliant, and they wanted us to, rep against that. And, if 2 years down the line, this buyer had done something wrong related to this transaction, our client might have to give all their money back. So there's an example where it impacted us. Of course, we told that person to go away, but
Right.
but it certainly is plaguing the smaller companies within the publicly traded markets. Definitely, I hear a lot of complaining out there, but there's good and bad to it. Absolutely, This is a graphical depiction of some of the strategic alternatives that are commonly contemplated with our clients. First one is a strategic sale, and we map it out with value and time. So, some of these options with respect to a capital raise will require our clients to hold their position for a longer time period, and how does that affect value in the future versus a sale right now where they're just getting out immediately. So starting with a strategic sale, as you can see, there's a flat line there. So value is defined as soon as they sell the company, and it stays static across time because there really is no time impact. A strategic recapitalization is an example of, say, a larger company within the same industry comes in and buys our client. There's a strategic rationale to the transaction, whether it's they need our client's service offering to complement their service offering, whatever the case may be. It's a strategic transaction. So that buyer is going to allow our client to cash out of 60% of their shares or whatever the case may be. But they're going to make them ride the rest of the shares into the future. So that gives you a different kind of assessment on your risk and your potential value into the future.
Along those lines.
Yeah, it fits somewhere in there. Yeah, depending on what the capital requirements were and whatnot. Next is a strategic merger with a VC-backed company. This is getting kind of granular. That's probably a similar example to the one that I just laid out, but the strategic acquirer has private equity backing. Sorry, we use this thing with our clients, so I don't want to get too in depth here. And then really the two distinct sets are, and everything in between is just a hybrid of both, is do I sell everything right now, or do I raise some growth capital and try and grow my business? And there are different ways to structure transactions in the middle there. But if you're going to raise capital to grow your business, you're going to go out to venture capital firms or private equity firms. They're not going to pay you what a strategic buyer is going to pay you because they don't get the synergies out of your business immediately. So they're going to pay you a lower valuation today, and then they're going to invest capital, which will allow you to grow your business more, and theoretically you should be able to increase value over time with that capital, which works in some cases and doesn't work in others, but that's how it is theoretically. Also with this step, we'll do a lot of valuation work. Usually our client's first question is, well, how much am I worth? What do you think I'm worth? So we have to have an answer to that. And we'll get in there, and we do very detailed, thorough valuation work. And this is really, I know you guys are very well educated quantitatively. This is where a lot of the quantitative aspects to this job come in, is really delivering a preliminary valuation to your client, which is typically shown in a range to your client. And it's very important from the M&A advisor's perspective too, because you want your client to have realistic expectations. So we don't want to work with a client for 9 months and know that they think they're worth $200 million, but we already kind of know that they're, when we take them out to market, they're going to command a $75 million valuation, and we're going to do 9 months of work, and they're going to say, oh, no thanks, we don't want any of those. And then we get paid at the back end, so it's a lot of risk for us. So this is a very important step in the process. And what we'll typically use as methodologies, which I'm sure you guys have certainly done work on in the past, is publicly traded comparables. That's a great indicator of value, is looking at the various comparable companies that have real market data where you can look at what they're trading at. Precedent M&A transactions, if you can find a similar private company to your client that has sold within the past 6 months or so, that's a great data point, because it's probably the closest thing you can get to your client. A discounted cash flow analysis, I'm sure you guys have done a zillion of those by now, but we'll model up the financial projections. We'll give a range of discount rates typically. Sometimes we'll apply a weighted average cost of capital model to estimate that range. And I also want to emphasize through all this that, as you guys know, valuation is a very subjective thing. It's an art. It's not a science. So everybody has different opinions. Our job at this point of the process isn't to come to our client and say you're worth, $25.6 million. It's to say, hey, based on these methodologies which we've outlined to you, we think you're worth between $20 and $30 million. Is that a comfortable range? Do you want to go forward with this process? And that's what we're there to deliver. So, I wouldn't say that we put in the amount of detailed work that would have to go into, say, a fairness opinion, where it's more of a liability to us, where we have to have a specific, really tight value range because 2 years down the road we could be sued over it. So here it's really just kind of triangulating, or depending on how many methodologies you have, getting your hands around the different valuation perspectives and kind of coming somewhere in the middle. So we'll also do a leveraged buyout returns analysis, which typically assumes a capital structure going into the company that involves debt to buy out. And I don't know how much work you guys have done with this, but it involves debt coming in to buy out the equity ownership in the company, and then you basically watch it grow 5 years, figure out what the value is 5 years out, discount that value back to today, and figure out what your returns are on making that investment. So that's the way a private equity shop would look at a company for an acquisition. So we like to model things up from their perspective. More often we use an EPS accretion dilution analysis. That's probably one of the most meaningful analyses that we do in determining what buyers will pay for our client. Because given the knowledge we have of our industry, we typically know that our client is going to be a very, very strong fit with this company, that company, and these 5 companies within the industry that are all publicly traded. We know what they're trading at. We have their financials, so we can actually go in and say, all right, here's our client's financials. We're going to combine the two and see what the impact is to EPS based on what a variety of different valuations they would pay. And really what we're trying to get to there is, where does it break even? What's the maximum valuation they can pay on our client to get to break even EPS, where they can go to Wall Street and say, hey, it's not dilutive, it's break even, we're not diluting value here. So that's a very big sensitivity we see within the public markets. So we do a lot of work around that.
How much resistance are you getting to, and from whom, if you're getting it, to you're representing the seller, running an auction process. Hey, I don't want to, you're running an auction, take us out. We don't want to be involved in an auction.
We get resistance to that. I would say it's usually from the more unsophisticated buyers, actually. Usually the larger strategic companies already, have the benefit of synergies already because things are going to fit nicer. So they know that they can pay really competitive values. So they're fine with getting into auctions because they know they're a strong competitor. It's the people at the lower end that don't have as strong synergy, whether it's a smaller company, some private equity firms, some financial investors don't like the auction process. I would say it's a very small percentage at the end of the day, because most of them you got to deal with it. I can certainly see from their perspective why they don't like the auction process. They like to knock on the door first and say, here's your $15 million and we're going to buy you out, versus having a banker tell them, oh, $15 million isn't enough. We got $18 million over here. It's got to be $20 million. Oh no, $20 million's not enough anymore. It just went to 22. So yeah, we get aversion. I mean, there's people clearly don't like auction processes. If you're a buyer, I wouldn't like it either. But it does what it's meant to do. It creates efficiencies within the market, and our job is to provide this value to our clients, and that's all we care about, is delivering the utmost value to our clients. So that's what we focus on.
I'm just curious what the typical problem is, or disconnect, of a seller that comes up with an ambitious, higher price than what you have in mind. And I'll give you an example. My brother-in-law has a company that he's in the throes of selling. It's very hard to talk him off the ledge. Entrepreneur, right? Grew this company, and he has an MBA, so it's an easy conversation. He knows how this works, right? And surprisingly enough, his view of the growth potential of the business and what's modeled are there. But the discount rate used for this illiquid jet fueling company, he can't get past. The rate of return that they're going to get is sort of built into that assumption. So when you have an entrepreneur that thinks the company's worth 40 versus you say it's worth 30, my guess would be, but maybe not, is it typically they just view the earnings projections as rosier than
Yeah, yeah. That's probably it most of the time. And, usually our clients have they feel like they have to have a huge hockey stick when they go out to market. And, we feel more comfortable. We like aggressive projections. But back to your question on how do deals get structured for smaller owner-dependent companies, those aggressive projections can come back to bite you because, when the buyer comes in and says, all right, this company's all dependent on you, we'll give you 70% up front, but we want you to produce this hockey stick. Yeah. And if you do, we'll give you the rest of the value, And, it's not all or none. Well, it'll be, on a tiering schedule or something, but I don't know if I answered your question or not. But that's...
You find a lot that they're selling you on a price also?
Oh, yeah.
You're going there, is it kind of going both ways, and they're kind of trying to say, well, look, we're going to...
Absolutely.
Be a maiden company in about 2 years.
Yeah, absolutely. And that happens all the time. All of our clients, I don't say all of our clients, but a lot of our clients try to, put a lot of effort into positioning the banker. It's just trying to get us to drink the Kool-Aid, for lack of a better term, and, really buy into their strategy. And, we're oftentimes guilty of drinking too much Kool-Aid with our clients, but, we need to keep everything kind of realistic in terms of valuation, and we need to be out there selling our client. We need to be positioning them with all the investment highlights and why they're just a fantastic company and how they're going to do this, that, and everything else for you if you buy them. But we need to be grounded in reality too, and we have to deal with that a lot. Our clients are constantly positioning us. So,
Jeff, help me out here for a second. I want to go back to Jason's question because this auction, Time Warner AOL. Time is under pressure to grow. Big public company. And sometimes because you're that big and an opportunity like that comes along, I think you're seeing maybe people reach to meet the market's expectations. Mm-hmm. And the auction process almost works against you and for the other side. I mean, it starts to get very complicated, but I want to talk to you a little bit about it afterwards.
Mm-hmm.
Jeff, are there tip-offs that you keep your eyes open for when you're talking to one of these very optimistic entrepreneurs? I mean, are there just words or phrases that if you hear, that's like...
In our industry, you know what it is? They don't see the value of our science. That's what it is. And I hope none of them watch this, but but they don't. They don't see the value of our science, and the value of your science is translated into the economics that you create from having that proprietary IP. That's a really hard thing for them to swallow, and I can appreciate it. I mean, these are scientists who have trained their whole lives to do some things that I'll never understand, some cutting-edge stuff, and have developed these incredible proprietary positions within a market, but maybe they're not the best business people. Maybe they haven't created the best business model around it. Maybe they haven't executed it the best way possible. But, in those situations, the way we would approach the market is, if we go to a much larger publicly traded company, for example, that would be our story. Here you have, this is the best IP position within this sector of the market. Just imagine what you guys could do with this. And if we get a couple of those that are imagining what they can do with it, you can price up value to levels that don't make sense, really, to what the asset you're looking at. So again, that's a really in the context of what we do, but that's something that comes out a lot.
To go to the Cayman Islands for the rest of his life, he's just looking for some magic number, $50 million, or is it a totally different piece? Because I think that's a kind of a businessman's mentality, right?
Yeah.
Kind of the thinking of some people in here that, you know what, I just got to hit it big for 3 years, I'm going to make my $20 million and I'm gone.
Yeah.
Right? Almost like a smash and grab job. Is that...
No, it's actually...
Is that how these guys are thinking?
No, rarely is that the case. It's typically people who are just passionate about building businesses. So they sell their business all they care about is, how long does my non-compete go? When can I do this again? Or what can I get into while I'm waiting for my non-compete to expire so I can start the next one up? That's what we see more often than that. Now, we've certainly come across, we've had clients that are, in their early 30s that have built up really impressive companies and have worked with their accountants to define what kind of nest egg they would need to have in place in their early 30s to give them an annuity stream and allow them to not work again. And those type of clients, we get a deal done, and maybe they'll go teach in an urban elementary school or something like that. There's those types of clients too, but more so it's the former, I would say. So I'll talk a little bit about the marketing materials. There's there's the confidential memorandum, or quote unquote the book is what everybody calls it, and it's it's a pretty robust document. It's usually, in our cases, they're usually 60 to 120 pages long or something like that. And they'll have an overview of the business, an overview of the industry, an overview of the financial performance historically, an overview of the financial projections, investment highlights on the company. It's a pretty exhaustive and tedious exercise to put these together, and you do it very collaboratively with your client. So hopefully your client has a nice business plan put in place where you can come in and leverage that. But for smaller companies, oftentimes you come in and there's nothing there, and I can't say I haven't written somebody's business plan before. I don't know if I did a good job at it or not, but sometimes the banker has to go beyond the limits of their knowledge to write some of this stuff. So essentially you want an informative document that's going to give everybody the critical information they need to know on your client to assess what they would be willing to pay for it. You also want to make sure you give them just enough information to do that. You don't want to give them the name of all of your key customers. We don't ever do that. We say, client A accounts for this much revenue, client B, client C, client D. There's a real sensitivity to confidentiality. So we'll disclose, who the key customers are, who the key suppliers are, get you into the contracts once you put your offer down, once we've signed up with you as the buyer and you're doing your due diligence. But until then, we're not sharing that information with you. So this is a very robust yet cursory look at the business. We do a lot of work in putting financial projections together for clients within our industry. We found it, and this is where a lot of the quantitative skills come in as well, but it's not so much from a valuation perspective, but more of a being able to project out a business from its core fundamentals, which I gave the example at lunch of a diagnostics instrumentation company, which say it's Quest or LabCorp is using this instrument to assess the cholesterol level within the blood sample of a certain patient. It's an automated instrument. It requires commodity-like reagents or samples of fluid that go into it that help to develop the output there. So the economics are that the client goes out and places this instrument within a lab. So they have this installed instrument. From there, the client's able to just keep selling these consumables. It's like the razor blade model. So they have these consumables that are feeding into it, and the consumables are 98% profit. They're incredibly profitable. So they'll go place the instrument at a loss or break even, and then they'll just feed it with consumables. So we can build a really nice financial model around that. We can show the installed base historically, we can show it projecting, we can show the average consumables per unit within the installed base historically. We can make an argument for that trend increasing going forward. But in the end of the exercise, what you want is as bulletproof as possible, a financial model that you can go out to the market, and once buyers start poking holes into it, you have answers to all their questions, which you can't do by, well, the industry's growing at 15%, so we're going to grow at 15%. You can't do it from the top down. You have to do it from the bottoms up. And, we get varying quality within the data available within our clients, so it's not always it's not always great, the end product, but we always try and make it as good as it possibly can so that we can defend it out in the market. At this stage, we'll also develop the buyer and/or investor list, which, we'll go out and do a very thorough screening of potential buyers in the marketplace or potential investors. If it's potential buyers, we'll look at what their strategic fit is, what kind of synergies they could realize, what their financing capabilities are. That's a very important one. You could have, a company that is the best strategic fit out there, but if they're, over-levered with debt or trading at an awful equity value, they're not going to be willing to pay as much, or they may not even be able to do the deal. So you don't want to go share your information, your client's information, with a company that can't afford your client, regardless of how strategic a fit it is. So, we'll also assess how quickly they can execute a transaction. One of the benefits we have is that we do deals in the same sectors all the time, so we get to work with a lot of the same people, so we know how certain companies move, which is really neat once you get to figure that out. So we know that, this big diagnostics company they're going to take 10 months, to do their work. Yeah, they're a great buyer for you, but they're not going to fall in line with our process, so I don't know if you want to wait up for them. Or we know that, this private equity fund is going to give you a really strong offer, but once they sign up with you, they're going to do their due diligence and they're going to try and, reprice your offer and tell you that, there's all these things wrong with your company. So we have unique insight into most of the buyers out in the marketplace, and we can provide our clients with that advice before they get into the market.
Which type of buyer do you like to work with? The strategic acquisition or the private equity?
That's a good question. They're both pretty different. I guess I like the strategic buyer most of the time because there's you get in and kind of quantify what the synergies may be with a transaction, which really lets you dig in and understand the growth strategy of each company and how they complement each other. So I like those, and typically the strategic buyer will pay a stronger valuation than a financial buyer, so we certainly like that. But I would say a strategic buyer. But it's hard to just make a blanket statement. Everything's different in this industry in every deal. So there are some really compelling growth strategies that a private equity fund may have, where they have a portfolio company that they want to buy our client to add on to, and then they want to create a third leg of the stool over here in this certain area, and there's a whole, you get into their whole vision and how they think they can create the next dominant industry model through acquisition. So everything is just very different in every different offer that would come in. So I like them both, I guess.
When you're developing the buyer list, is it more of your diligence finding these companies, or does your client know certain companies that they would do synergies with?
That's a good question. It's both. It's given that we are in this industry all the time, we have pretty good knowledge, but oftentimes, in a lot of the cases, it's our clients are companies who have already had knocks on their door. So they've already had somebody come in and say, hey, we're interested in acquiring you, which has caused them to contemplate, all right, is the market timing right now? Because I'm getting knocks on my door. I never had this before. Maybe I should go talk to a banker. And then we can come in and say, well, yeah, there's those two people, but there's these 5 other people, too, that are knocking on doors, too, and there's a real market out here right now. You may want to consider it. And here's what valuation is looking like. So oftentimes our client already has a couple people at the door. In a lot of other cases, too, our client will bring up names that we didn't know about. Maybe they're just so kind of out of the box in terms of the strategic fit that we didn't realize that, Microsoft wanted to get into metal bending. Like, wow, okay, well, they're knocking on your door. Yeah, we'll talk to them. Okay. So, our clients oftentimes bring some pretty interesting ideas to the table, and sometimes those are the ones that get the deal done. So. Next is executing the marketing program, which takes about 1 to 2 months. Typically, what we do is we put a teaser together, which is 1 or 2 page, very high-level overview of our client that is all blinded or confidential. So we don't disclose our client's name. It just says, we'll usually give it a project name. So it's project this, and it just describes this company without disclosing the name, but it'll tell you enough to know whether you should be interested in it or not. It'll tell you what kind of business they run. It'll give you a very high-level overview of what their revenue and their earnings have been. It'll tell you what the investment highlights are in very summary format. And we'll give that out to the market. We'll go out and get that distributed to everybody on the same time frame. And then we'll follow up, and for those parties that are interested, we'll have them sign a confidentiality agreement.
The teaser, do you fax that, or you email it, or both, or do you?
That's a good question. Back to the confidentiality, you just want to make sure that it's going to the right place. So what we do prior to distributing a teaser is we do buyer verification, we call it. And for us, it's really easy a lot of times because we're dealing with a lot of the same parties. We already have relationships, so we know how to get it in the right hands. But for those parties we may not have worked with in the past, we'll call up the corporate development department and say, hey, who's responsible for looking at M&A opportunities within your practice? And hopefully they can give us exactly to the person that needs to be looking at this, because we don't want to send it into the main fax line into Becton Dickinson or some big company to where somebody has to hand it to this person, this person, this person, this person, and then it gets to the right person, because then there have been 10 sets of eyes on it before the right set has been on it. So typically we email just because we know who the right person is. But if we fax, we try and make sure it's a direct fax to the right person. So once people have determined that they are interested from reviewing the teaser, we will get them to sign a confidentiality agreement. So that's them saying, all right, I'm interested in this enough to tell you that I'm going to take a little risk here and sign this confidentiality agreement, and let you know that I'm not going to use any of this information to my advantage, and if I do, you're going to come see me. So I'm agreeing to that, which is in a lot of cases is a big risk that some of these buyers take. If it's a buyer that is looking at our client, and our client's in an area, a service area that they desperately know they need to get into, they know they're going to have to go into it, whether it's buying our client or building it themselves. So they know if they sign this confidentiality agreement, it's meaningful. It's something that if they don't go through with this deal, they're bound to what they've seen essentially. So sometimes it can get tricky negotiating those things. Sometimes it's easy, for companies that don't see any risk there. But sometimes we get a lot of red lines and changes and edits going back and forth. So once we do that, we'll distribute the memorandum to them after they've signed the confidentiality agreement. And we'll do we'll answer their questions. Us as bankers will answer their questions just to try and get them up to speed and build more interest. Concurrent with all that, we'll start preparing the management presentation, which at a future point, buyers will come out and get the full dog and pony show from the management team and get the facility tour and everything. So we'll start preparing a professional presentation that positions the company that way. And we'll start assembling the data room, which a data room is essentially all of the legal documentation, all of the contracts. Basically if you were to go buy a company, you'd want to see all of the contracts they have with their customers, everything they have with their suppliers, every confidentiality agreement they've ever signed, all of their employee contracts. You'd want to sift through all that stuff to make sure that there were no risks that you were taking. So we'll start preparing that. We do all that stuff online, which is how a lot of people are doing it nowadays. We have our own secure IT infrastructure in-house to where we have a portal and we can load all the documents electronically and give people passwords to get in and view the documents. So it's a lot quicker to get deals done recently. And also at that time, the lawyers will start drafting the purchase docs, which will be what's signed at the end of the deal. From there, you go into preliminary due diligence. We'll request. We usually do it in a two-step process. We'll request indications of interest based on preliminary information we've given to buyers. So we want the buyers to come back and say, hey, we think you're worth, between 30 and 35 million, and this is how we would foresee structuring the deal. These are some of the contingencies we would want on buying this company. We would want to make sure that we had done full due diligence on the operating facility you have in Puerto Rico or something like that. And we get that just to get a cursory feel for the market and also to determine who we want to bring forward, because the parties that come forward from there get to see a lot more confidential information than the parties that don't make it past that. So once we've done that, we'll bring in really a handful of potential buyers. We'll allow them to come to the facility, get a management presentation, do a tour of the facility. We'll give them access to some of the data room as well, maybe not all of it, but some of it. And we'll make sure they get every possible question that we can answer answered so that they can put in a final offer on our client. And then final offers come in. Again, we'll negotiate with the various parties. We'll help our client assess the economics of each potential offer, and we'll try and show them comparatively across the board. And back to your question, a lot of times it'll come up that our client's chemistry with a specific buyer is just phenomenal. They love the strategy of the company, but the company's paying $2 million less than this other company, but they're still going to take it, and we can't get any more value out of that buyer. So all of those things get figured out at this time. Our client will sign a letter of intent, it's called, which will be binding in some respects and non-binding in others, which basically outlines all the economics of the deal. So it says your value is this much, the structure of your deal is this way, we're going to give you 80% cash and 20% stock, and we're going to close within 60 days. And what the buyer gets from that by agreeing to all those terms is the buyer says, all right, well, you can't go talk to anybody else. It's just me now. So the seller said, okay, it's just you now. If you give me this price, I'm not talking to anybody else. And that's called a no-shop. And that's critical at the end of every deal. So at that point, the buyer comes in and really starts spending money on due diligence. So they're bringing the lawyers in, they're bringing the accountants in, they're going through all the documentation to make sure that they are doing the right thing and buying the company without a lot of risks attached to it. So then the purchase stocks will get negotiated too, and there's a lot of legal wrangling that goes on there with the representations and warranties and whatnot, but I won't get into all that detail here. So I just wanted to close with a case study. So I've given you kind of the just generic steps to an M&A process as a banker would manage it. But now I'll give you a client that we had that we closed a deal for earlier this year and just kind of walk you through how the path of their process went. So we started working with Primus Corporation, which is a diagnostics company that develops instruments that go into labs to do blood testing. We started working with them. They have three. This was mid-2004, and they had three shareholders. The CEO owned a majority position. Actually, didn't own a majority position. He owned 40%. And the two other shareholders, who were passive shareholders, they were just local investors that put money in, owned the remaining 60%. So effectively, if the two passive shareholders decided something, that they had majority vote. So there were some differences in opinion on, who wanted to liquidate their ownership, who wanted to stay with the company. The guys who were passive owners didn't really, understand the business thoroughly. I mean, they understood what the company did, but they weren't there day to day knowing what the company was facing and as far as opportunities and threats go. So we started working with them and contemplated whether to go and raise capital to maybe cash out a couple of the shareholders or grow the company, or whether to just sell the whole thing. And we showed them all their alternatives economically and started talking with a private equity firm that we knew had a very strong strategic fit with a portfolio company they had. While that was going on, our client came across this other company out in it was actually a product line that was being divested from a large public company, and they decided, hey, this is a really good opportunity. We want to go buy this asset out of this public company. So we had these two things going on, and we had to figure out, where do we focus our attention to give our client what they really want. And what we ended up doing was working with our client to look at this acquisition opportunity they had. We structured terms around that and got a good position with that asset. And we took those terms and we took it back to the private equity group and said, hey, we want you to invest in our client and we want you to fund their acquisition, and look at what value they're getting this acquisition at. So we want you to pay more for our client effectively because they've added more value to what they're bringing to the table. And by doing that, we were actually able to structure an above fair market value for our client in that deal. Subsequent to that, the company, the product line we went out to try and acquire was bought by somebody else. So we didn't get it at the end of the day. So our whole deal fell apart. So back to the drawing board. Then we went out and did a full marketing process. They said, all right, we want to go out and sell. So we went out to all the logical buyers out in the marketplace, ran a full process for them, spent 4 or 5 months putting that together, brought in 4 or 5 offers. We had offers from companies in India. We had offers from companies in Europe. We had offers in the U.S. We showed all these really distinct offers to our client. Client picked one offer that they were really comfortable with, and I can't disclose too much, but it had a really unique structure that they really liked. So got into that deal. Did all the economic assessment around that, got them comfortable. They started moving forward. They gave a no shop to these people and said, all right, we're not going to talk to anybody else, and we didn't. So we kept going. A couple months into due diligence, or a month and a half or so, this particular buyer said, you know what, there are all these problems we didn't realize before. We can't pay this anymore. We're not going to be able to do this. We need to reprice this deal. We need to shave a couple $1,000,000 off here to make sense of this deal. So we were faced with another unique set of decisions we need to make. Do we let them reprice and get this deal done? Do we say no, we're only doing the deal at terms we had, and we're going to wait till our exclusivity or our no shop expires, and we're going to go talk to the other people that put in offers? But at that point, a month or two had passed, and we didn't know if the interest was still there with the other buyers. There was a lot of uncertainty around the decision. So what we did was we decided not to go forward with that buyer who was trying to reprice, and we were able to negotiate with them to allow us to get out of the no-shop clause, and we went back out to who we thought was the next best buyer, and we got a deal done with them. About 30 days later, we had it closed. So you can see how many twists and turns and engagement can take, and I gave you kind of the generic overview of the process, but any client can have different motivations or unique opportunities arise throughout the process because you're managing something for a 5 to 7 month timeline. Lots of things can happen. So everything is very, very unique, and that's what keeps this job interesting. I mean, if without that, it would just be running through the same old process and doing the same analysis. But it's all of these things that keep you on your toes and make you constantly think about what the alternatives are and what your client's best alternatives are in your mind, and help your client determine that. So it's very satisfying. It's a great profession. And that is the end of my presentation.
How many times have you gotten down to the pretty close to, sign a definitive agreement, and you run into what some of you probably heard of seller's remorse or pre-final seller's remorse?
Oh yeah, that happens a lot actually. With especially that happens the most with the founder who's built his company up over like 15, 20, 25 years. This is a huge deal. This is him ringing the bell on his company, and it's his baby. It's his or her baby. It's do I want to do this, or can I stick it out for a few more years? So we definitely have clients who, they call us back. I just took a long walk around. I just did like 4 laps around the block thinking this through. That happens all the time. I mean, these are very significant decisions, and from that perspective, I mean, you can see how the M&A advisor's job can be very, very stressful. I mean, just psychologically, you're responsible for providing advice to somebody who's making such a huge decision, and oftentimes our clients aren't huge companies that are just kind of cranking through the next deal. It's that entrepreneur that you just have just tremendous respect for what they've done, and you realize how significant of an event this is, and you're the one there that's supposed to be helping them through it. So it's you need to be available in all hours of the night. You need to talk them through their decision making, which sometimes can get emotional. It's again, from that perspective, it's very satisfying as well. It's great to have a successful outcome for a client like that, where they're happy with what they got. There's nothing better than that. It's fantastic.
Suspect that, apart from whatever intrinsic ethics you you guys have, I guess in terms of some of these transactions like this, it behooves you well to be very understanding of management, not try to strong arm, because you do swim in a very small pond.
Mhm.
That's kind of, if you want to create a reputation, that's what most of these people are.
Yeah, and it's both with the buyers and the sellers.
They
You
all
know.
hang out with each other.
Yeah, definitely. Yeah, it's you know, the thing that we have to deal with the most, especially since our business is doing really well right now, is people are perceiving us as the experts in the sectors that we work within. So, you know, we're getting a lot of people coming to us, and you know, we can't work on two of the same company at the same time. I mean, we can't go out and show the same buyers, hey, you can have this one or this one, you know, because our clients won't be very happy about that if they choose the other one, you know. So when we make a decision, we commit to that client. So we, you know, if another prospect comes up that's 3 times as big and the fee's 3 times as large, we say, no, we can't work with you. We're conflicted right now. Sorry. You know, if you give us 6 months, we can work with you, but we can't right now. So yeah, we face a lot of that. It's tricky, you know. It's very unique in that, you know, I don't think a lot of investment banks have to deal with it as to the extent we do, given how narrowly focused we are. But
Anybody else have any questions?